share and support. Thank you very much, Carmen. Share and support at all times any Indigenous initiatives that are appropriate to the setting, and use your platform as an amplifier for their messaging and events. Good afternoon again, and I would like to ask that if you do have a question that you submitted in the Q&A box at the bottom of your screen, please note that we will do our best to answer your questions as time permits. As you can see, we have a very stacked panel today, and so we're very excited. I would also like to inform you that your participation today remains anonymous, and that you can ask your questions anonymously by selecting that option through the Q&A box you see. Welcome to our session entitled Taxes and Business Transition, with a presentation from MNP partners Joel Ahrens, René Duroy, and Luc Lamarche. My name is Cameron Grant. I am the Senior Policy Analyst for the Chamber and your moderator for today's session. I want to extend a special welcome to any business or organization joining us across the 32 Northern Chambers of Commerce. The Chamber continues to facilitate programming under our Reimagine Resiliency series. It is a series to ensure that businesses can navigate any storm. Under the succession planning pillar, or what we present to you today, which is proudly supported by Genier Financial, Maisonneuve Dawkins Lawyers, and MNP, we welcome Joel, René, Luc, and their team, who will guide us through today's session. Transition planning can be daunting for owners and small to medium-sized enterprises who lack the appropriate resources. In 2019, the Chamber reported that 73% of small and medium-sized entrepreneurs lacked a viable succession plan. We are now, under the Regional Economic Development Program through OMAFRA, are conducting a benchmarking report, which will be launched in the coming days, to identify where those businesses were in 2019 and where they are now in 2023, particularly with the pandemic in the mix. This obviously came as a concern, as 78% of those surveyed identified and indicated that they would look to sell their business in the coming 5 to 7 years. So it is appropriate that we're holding such a session today. Access to information on valuing your business ranks second in the list of barriers regarding transition planning. So without accurate information, financial and transition plan and valuing the business can be very complex, leaving many unsure where to start. Access to affordable, confidential, and professional advice is critical when drafting a transition plan to ensure the successful sale of your business. Today, we hope to provide participants with information that assists in building capacity regarding succession planning. I want to take this opportunity to mention that those on their local group insurance plans through the Chamber this is a reminder that our plan has a retiree plan coverage. So reach out to your Chamber for more information should you wish. I do want to provide a little bit of information and background on today's presenters. René Duroy is a partner in taxation services with MNP, practicing tax for over 15 years. He does service the Sudbury and Timmins areas and assists business owners with divestitures, tax planning, and estate planning, as well as he is the regional leader within their tax controversy practice. Very fascinating title. Luc himself is a member of MNP's Assurance and Accounting team in Timmins. With more than a decade of public accounting experience, Luc is a trusted advisor who makes it a point to understand his clients' unique needs and situations. Luc's assurance services encompasses financial reporting, personal and corporate tax planning and filings, business strategy, wealth management, and financial planning and retirement planning, critical for today's presentation. And Joel, of course, is a member of MNP's Assurance and Accounting team here in Timmins. Joel helps non-for-profits, public sector, and for-profit organizations, particularly small business, achieving their goals and building success. Joel is experienced with financial statements, audits, internal control testing, and auditing procedures. He also provides hands-on experience to help the team conduct the engagement, ensuring work is on schedule and appropriately timed. More appropriately as well, Joel is involved in the community in various ways and currently serves as the treasurer right here at the Timmins Chamber. For the past 2 years, he has helped invigilate the CPA Canada exam for up-and-coming accounting professionals. And so I'm very pleased to be joined by 3 highly skilled and technical service providers here within our community and within the North as well. So I am going to stop talking because I've done enough of that. And I'm just going to assure attendees that please, at any time, if you do have a question, just pop it into the Q&A, not the chat, the Q&A box that you'll find at the bottom of your screen. And then further to that, we'll see if we can answer those questions as we go along. For our panelists today, I will be monitoring the Q&A box. And so if I do interject, it's only because I feel the question could be answered as we move along rather than at the end of the discussion. So from here, I will pass it on to our panelists, and I do wish you productive discussions as you lead us through today's presentation. So on to you, gentlemen.
Hello. So my job was basically to introduce everybody, but since Cameron did a better job than I would have, I will skip over that part. So my name's Joel Ahrens. I am a partner. Luke and Renee are going to be going through the presentation on succession planning. I'm going to be in the same boat as Cameron. I'm going to be there to help answer any questions in the chat. So, or the question and answer. So if you have any questions, feel free to answer them. And I'm going to pass it off to Luke to get started.
Perfect. Thank you for that. Okay, so today on the agenda, what we have is about an hour-long presentation, and it's really a high-level kind of succession session where it's going to give you some key aspects of succession. So what it is, why it's important, some elements of good succession, as well as approaches to consider. And then Renee will take you through some tax considerations, as well as planning opportunities and potential tax traps as well. And then we'll, of course, open things up for questions at the very end. So again, just put your questions in the Q&A box, and we'll do our best to answer those at the very end there. So what is succession planning and why is it important? So to put it concisely, succession plan is a comprehensive roadmap to successfully exit a privately owned business. So I use the term there comprehensive in the sense that it really looks at all aspects of the business. So the business activities, the owners, the employees, and all the people involved, as well as their families as well. It impacts everyone in the environment there. So it looks at the financial as well as the non-financial considerations. And then it puts a step-by-step plan in place to achieve whatever desired result is of the exiting business owner. And ultimately, the goal is to maximize values, minimize taxes, and help the owner reach his or her financial and non-financial goals. So important thing to note there, again, is no two businesses are the same, and the objectives of the exiting business owner are never going to be the same. So again, why our presentation is at the very high level. We're not going to be showing you the ins and outs and the intricacies or what's involved in the very specific details of a succession plan. But again, why is it important? Some common areas and traps and opportunities as well. So Cameron did touch on some stats, but I also wanted to just share this quick slide here, which is a survey from the Canadian Federation of Independent Business. It's their November 2018 survey, so it's a little bit dated, but they do these every 5 or 6 years. And this pie chart really hasn't been changed in about 20 years. So it's relatively the same stats for the past couple decades. And really what it shows is that over 50% of business owners do not have a succession plan whatsoever. And in fact, probably haven't even considered what succession or transition means to them. The next piece of the pie, the bigger chunk, is the 41%, and those are the business owners that have an informal plan. So again, it's a pretty vague term in terms of what is an informal plan, but really what that means is they've at least thought about succession. What does that look like? Maybe they've identified potential successors, a mechanism in which they can exit the business, and possibly thought about some structures and started putting some of those steps in place. There's nothing written. Most of the times when I meet with people and they have this informal plan that they've thought of, it generally is sitting in the business owner's head. They haven't communicated that with other advisors or with family members, key employees, management. So it's really important that we're moving towards having that formal written plan. And that's unfortunately the smallest piece of the pie there. They see at about 8%. So that would be a comprehensive plan. It's written down step by step. People know what their roles and responsibilities are, what the value drivers are for the business. We're building up the value up to the point of exit, and we're leading to a good succession. So really the goal today is to teach you that succession is important. It's probably one of the biggest life events of a business owner. So planning is important. We want to do it ahead of time, and we want a well thought out plan. So why do entrepreneurs avoid it? Well, first, they're unsure about what is involved and how to start the process and whom to call for help. So like I said, there's going to be a lot of variables at play here. There's the business, so managing kind of the day-to-day, you're managing the relationships with your employees, with management, with customers. There's family members potentially involved. There's a lot of variables there. They just don't know how to get started. So what I say to that is, let's just start a conversation and we just start from there. So just reach out, we have a discussion. Business owners also have a difficulty in discussing financial matters and personal goals with others. We see this a lot with generational companies as well. So mom and dad are the shareholders. There might be some kids involved. They haven't been involved in the financial management kind of side of things, and they don't really understand or have been communicated what their parents' goals are going to be. So it's just a matter of putting it all there on the table, understanding what people's goals, their desires, their wants are, and having those discussions. There's also a fear of causing conflict between family members. And again, we're seeing this in generational type transfers where there might be multiple children. Some kids are involved in the business, others are not, or they're not involved in the same degree. So how do we transition this to family if that's ultimately the business owner's goal without causing too much conflict? And again, it's about having discussions early, upfront, and determining who the best successors are and really putting thought there in the decision making and making sure everyone's on the same page. There's a fear of giving up control. So again, you've built up this company, you've managed it for many years. You, as the business owner, may be in charge of all decision making. So there's generally a fear there that of losing that control once you start transitioning. Business owners also tend to spend a lot of time managing the day-to-day requirements of their business, and they do not believe that they have the time to focus on long-term planning or planning for themselves. So again, there's a lot, we're living in pretty chaotic times. There's a lot of time pressures, a lot of commitments. You're servicing your production, your day-to-day activities. I think the biggest thing there is just understand how important this life event is, and you're prioritizing and making time to plan for it. They believe that the time is not right to start the process. So a perception that an exit plan is only needed when succession is imminent or when an exit becomes necessary. So again, we don't want a critical event such as a heart attack or sitting on your deathbed and now you're starting to think about transition. How am I getting out of this business? It's a plan, it's a process. It takes a long time to put in place properly. So we want to be starting early on, much in advance of your planned exit of the business. I would say kind of what I generally advise is about 5 years for sure before you're exiting the business. But typically we're seeing 3 to 5 years, and in some cases even longer than that as well. The entire process just seems too daunting, and business owners want to avoid the stress. So again, like I said, there's a lot of variables at play here. There's relationships involved, customers, employees, management, family members. It could be family drama dynamics that are complex. Sometimes it's just too daunting. They just don't want to deal with it at all. So what I say to that, again, we just got to start somewhere. Let's start the conversations. Sometimes it's easier with having an advisor in the room and we have those conversations, but we need to get that process started. And finally, they're just not sure what they'll do once they're no longer involved. So again, they've been in a business for an extended period of time. A lot of business owners have been consumed by their business, the day-to-day management of that business, and it's basically their livelihood. So what are they going to do when they ultimately retire? We generally see that there's a bit of a fear of kind of letting that go, and what am I going to do with my time after if I'm not in that picture? So, so those are another reason why entrepreneurs avoid succession planning. So why is succession planning important? Well, with many baby boomers planning to retire in the coming years, business succession is a major concern. According to the 2018 survey by CFIB, so the same survey that we saw that pie chart from, over $1.5 trillion in business assets will be in play over the next decade, as nearly 72% of small business owners intend to exit their business. So the biggest struggle that those business owners are experiencing at the moment is actually finding a suitable successor for their business, as there is a lower number of younger generations of entrepreneurs. And we're seeing that even to a higher extent in Northern Ontario, I would say as well. So we need to be planning ahead of time to be identifying possible successors, possibly training the successors to be successful when it's time for the ultimate exit. So it all makes that succession planning all that much more important to business owners. And effective planning then provides peace of mind for the business owners. So we're able to identify the goals, the wants, desires, potential successors. We're building them up for an effective transition, which increases, again, the value of the organization. So we're identifying the value drivers. So that could be, the systems, the processes that have to be in place, so that we're exiting when the organization has significant value. And then ultimately, effective planning will also provide some significant tax savings, which Renee will take us through afterwards. So succession planning is a process, it is not an event. So what I mean there is, it's not a one and done thing where we meet for a few hours, we have a plan, and we kind of see you later when it's time to retire. It's a long process. It starts off with identifying, again, your wants, your desires, your needs, your desired outcomes when you do transition. And then we can build a kind of a step-by-step process or plan, I should say, of how we're going to achieve that pre-transition, at exit, and then ultimately post-transition or post-exit when we're monitoring how that succession took place. So it's about family, people, and relationships. It's not one person's problem. So it's not the exiting shareholder's problem or mom and dad's problem. All family members, especially if it's going to other generations, how is that family impacted by that? Their spouses, well, how do they feel about that? What's their views? What's their vision for the future? We're looking at the relationships, not just within the business owner group, but with customers, with vendors, key management or employees. All of that is part of a succession plan. It's also about ownership, management, and an estate. And it's not simply just a tax minimization planning item. So of course, a tax reorganization, and Renee will go over some key structures and planning opportunities. It does make up a significant part and an important part of a transition plan. It's only about 10% of a true transition plan. So the other 90%, again, is dealing with succession, dealing with the people issues, making sure your business is successful leading up to transition and after exit as well. It's about what is fair and not about what is equal. So you'll hear me say that a few times. What is fair is not equal. What is equal is not fair. That is something that business owners struggle with a lot when we're dealing with intergenerational business transfers. So especially when there's multiple kids, the children may not be involved in all the same fashion in the family business. So how do we transition this out to a family member or a child? If that's the ultimate goal of the business owner, and we're fair between all kids, but not equal, of course. So it's a tough conversation. Generally, again, it's easier if there's a advisor in the room to kind of facilitate that conversation. But we really have to have the business owner think through what is reasonable and what is fair there. We're not jumping to conclusion about just splitting that 1/3 and the kids carry on. It's driven by family values, wants, and concerns, and it's not driven by technical issues that are handled by lawyers, accountants, or financial planners. So again, we're identifying what the family values are. Is the legacy important? What's the vision of the company? What values did you run your business by? Do you want that to continue on post-succession or post-exit? What's important to you? What's your desired outcome? And we're going to build a plan that's going to be fulfilling that outcome for you. So some elements of good succession. So when I'm approached by a client and we're having some preliminary discussions about succession, what I'm really trying to do at first is identify what their objectives are. And what I do is I look at these 3 pillars. And the first one is the retirement pillar. So I try to determine there, what lifestyle do they want in retirement? And basically when we boil it down to, and we work through the issues, is we're identifying maybe and preparing a retirement budget, which will lead to a retirement financial plan. And really what we're trying to figure out is what cash flows do they need to sustain their retirement lifestyle that they want. And why that is important is that a lot of owner-managed businesses, their personal wealth is primarily tied to their business, or maybe some cases it's entirely in the business. So what needs to be extracted in a transition or an exit from that business to be able to sustain that lifestyle in retirement? So we need to have a good understanding of what the incomes are going to be, the expenses, and the asset pool as well. The second pillar is the succession pillar. So the purpose of this one is really we're identifying who the best successor might be for the business. The important things there, again, we're maintaining and increasing the value of the business in the transition period up to exit. Some key considerations there, again, is retention of team members. So if we have key team members that are going to be important after exiting the business, we want to make sure that their needs are addressed and they feel valued and important to the business. They're going to continue to do what's right, to build value. They're motivated, and it's going to be great for succession. And we're also looking at the roles and responsibilities and relationships. So if the current business owner is charged with 100% of the decision-making, has all the relationships with the employees, with management, with customers, with vendors, that is not a good transition plan. So we want to be looking at transitioning those roles and responsibilities over time. So we put a plan together, and step by step, we kind of delegate those roles and decision-making responsibilities to that next level or successor, identified successor. And ultimately what we're trying to do there, and we do that many years in advance of the actual exiting, which also functions as a form of emergency planning. So because you never know what can happen. So we want to have a secondary management team or someone that knows the processes, the systems, the people that could step in should something happen, a critical event, in some case, the business owner is no longer available or not available for a period of time. Someone can step in and the business is relatively unaffected. So the purpose of that pillar is, again, we're identifying the best successor. We're kind of separating the business to some degree from the business owner. So we want a self-sustaining business that could run with a secondary management team. The third pillar is the legacy pillar. And really the question there is to the business owners, do I care what happens to my business after transition? So you ran your business with a certain set of values, you built a name in the community, a reputation, you have a vision, you're passionate about that. Do I want my business to continue with that same culture, those same values when I exit? Or do I just want to cash out and get the biggest check I can and really be sitting in the Bahamas sipping on a martini on the beach? So that's really that third pillar there, is how important is that legacy component to you versus kind of cashing out and making the most money. So a well-designed plan creates options and allows business owners to control how and when they exit, ensure that all shareholders' interests are respected, maximize company value in good times and in bad. So again, what we're doing in this succession plan is we're identifying value drivers, and we're making sure that those value drivers, if they're not in place, they are put in place. So again, we're building the financial accounting systems, processes, secondary management teams, people that can step in your shoes should an event occur, and the business is, again, it's kind of self-sustaining. So that's the purpose there. It minimizes, defers, or eliminates capital gain taxes. And again, Renee will touch base on that in a little bit as well. Reduces stress and the risk of family discord. Again, we're doing this ahead of time. We've got many years. We're interviewing and having discussions with family members. Ultimately, the goal, everyone's on the same page at the end. Again, we're making decisions that are fair. They may not be equal, but if we're having those discussions up front, we're getting everybody's viewpoints. We're taking that into consideration before we make the determinations and ultimate decisions. It generally reduces that risk of disputes. And finally, it organizes and prepares the incoming ownership and leadership team to continue to grow the company. So we're identifying who the best successors are, the management, key employees. We're putting measures in place so that they feel valued, they're motivated, they're doing the right thing, building value, and ultimately it leads to a self-sustaining company that you can essentially exit and is generally unaffected. So this part of the presentation is some common exit options. I'll highlight a few of these from the point of view of succession, some high level kind of pros and cons, some of the soft issues. And then Renee was also going to be looking at these exit options from the viewpoint of taxation, tax opportunities, structure planning, and things like that. So I'm going to highlight a few of these in that sense. And generally there's about 5. So you can close down and liquidate assets. You can sell to an arm's length party today. You can sell to an arm's length party in the future. You can sell to management or employees, or sell or transition, sometimes it's gifted to family. So there's a general 5. I'll highlight a few of these. The first one is a transition to family. So a lot of owners wish to transfer their business to family members. And the statistic is roughly about 1/3 of companies will transition that way. This is done primarily for non-financial reasons, leaving the business in the hands of someone they know, trust, whom they believe will continue to run the company as it has been run for years is of paramount importance to these owners. So some of the pros there is, again, the business is going to a known entity, so it's a family member. You know who they are, you know how they operate, you know their values, their vision. So there's comfort in knowing that they will take on the business. There's increased likelihood of culture being retained. So most of the time, the family member, the next generation, has been ingrained in the family business for quite some time. They have relationships with the employees, with other management, with some of the customers. They've lived that culture. So most likely, when they carry on as successors, that culture will be retained. The legacy and perpetuates family vision. Those kind of go hand in hand. Again, you're choosing this option generally to carry on that family legacy, the family vision. It stays in the family name. That's very important to these owners. It allows the owner to remain involved with the company. So if they want to be involved, they get to be involved to some degree. And it also helps with the successors as well, because they know that, hey, maybe mom and dad maybe have encountered some issues in the past. If I encounter that same issue going forward, I have a resource there to bounce ideas and resolve some issues as well. It provides opportunity to family. So it provides the next generation an opportunity to be business owners as well. Some of the cons to this plan is possibly less cash at closing. There's increased financial risk if owner finance. What I mean by that is generally the next generation of family members, they don't have the financial resources to buy out mom and dad up front. So you're not getting a large check when they're paying you out. Most of the times there'll be some kind of vendor take back loan, and that loan is going to be financed with some future cash flows of the company. So there's some financial risk there. There's required owner involvement in company post-closing. So we saw that as a pro. We also see it as a con. It really depends on that business owner. Did they want to just be retired and off on the beach somewhere? And now they have to be kind of involved in the business, especially if there's some kind of vendor take back and future cash flows of the company are being used to repay some of the extracted wealth that you need from the corporation, because you want to make sure that the company is succeeding so that you ultimately do get paid. So that can be a con if you really didn't want to be involved. You're exhausted. You don't want to be part of the company anymore or the operations. There's risk associated with children's ability to assume the ownership role. So we do as much planning as we can to identify against strengths, weaknesses of the children. They may be good employees, but we ultimately don't know how they're going to be in that ownership role until they are in those shoes and dealt with those responsibilities. There's always going to be the fair versus equal considerations. Again, we're doing what's fair, not what is equal. So if there's multiple kids, we're not splitting that equal shares. Who's involved in the business? Who should ultimately be the successor? And we're also dealing with family dynamics. So families are getting more and more complex, it seems. So if you've got even extended family involved in the family business, that just complicates the family dynamics there as well. The second option is a sale to management. So in terms of advantages and disadvantages of this option, it's really remarkably similar to option one, which is the transfer to family members. And the owner who considers this type of transfer hopes to achieve really the same objectives as the owner transferring to a family member. And that's that succession and legacy pillar. We're not too concerned about taking the most cash at exit. So one thing to remember there is, again, I want to highlight that there's always going to be a risk there. Purchase price comes from future cash flows of the company, which ultimately is something that happens on this option as well. So that you're always putting and taking a chance on the future there as well. So you'll see that as a con in a second. But just going over the pros of this option is, again, it transfers the company to a known entity. We know who our management is. We've been working and dealing with them for a long time. We know their values, how they're going to ultimately run the business. So we take comfort in that. It's a good retention and motivation strategy. So ultimately, if they know they can be business owners one time, and especially if we're doing this planning ahead of time, 5+ years before the ultimate exit, they're part of those discussions. They know that they have an opportunity to be a successor. So that's the motivation for them to do all the right things, continue to build value for the company that will ultimately be theirs at some point. It allows the owner to remain involved in the company. Again, that could be a pro and a con, really depends on how involved you want to be. And it provides opportunity for the next group of owners. So again, we might have some very motivated people. They want to be business owners one day. So if we're identifying that early on, we're keeping those key employees as opposed to losing them to some other opportunities. Some cons there, again, relatively the same as the first option. There's reduced cash at closing. You're not getting the fat check, most likely from management. They're in the same position as the family. So they most likely don't have the financial backing to just pay you out outright. So there's most likely a vendor take back loan, which will be funded with future cash flows from the company. The owner involvement post-closing, that could be a con, again, depending on how involved you want it to be when you do exit. And there's also a risk of selecting the wrong employees to be owners. So again, we can do as much planning as we want to identify strengths, weaknesses, develop a criteria for assessing potential successors, building their weaknesses. We ultimately don't know how they're going to be until they step into those shoes. The third one is relatively similar to the second, but it is through a share ownership plan. So ultimately, generally what we see here is a progressed kind of involvement by the employees through share options. And some of the pros there is that it aids in building engagement and culture. So again, they're being compensated with some stock options. They're seeing that they can own a part of the company. Part of their compensation is going to be tied to that. So the more the company is worth, ultimately, the more motivation they're going to have to build value there. It provides an opportunity to identify, develop the next leaders. Again, it boosts productivity and customer relations. So there's, again, that motivational aspect of being an owner that creates that extra productivity. And what's great about this plan is they can actually be used as an interim strategy to build value before sale. So if your ultimate goal and your desired outcome is to sell to a third party, you want to have the most value at the time of sale. This is a great way to motivate your key employees to build that value leading up to the sale. Some of the cons, again, reduce cash on closing, increase financial risk. So most likely there's some kind of financing from the exiting owner. The owner likely wants to be involved post-closing because the future cash flows are going to be used to repay the exiting shareholder. It may not be possible to foster ownership mentality among employee shareholders. So that all depends on the employees. It depends on how much shares they're getting. If they're ultimately going to have 5% ownership in the company, is that really going to be motivating to them? Do they really feel like they're going to be part of the ownership group with owning such a low minority interest? And then ultimately, you will have to share some company information with them once they're shareholders. So that potentially is a con if you don't want them to have access to that information, or there's information you don't want them to have. Finally, there's the arm's length sale. So when there is an external market, the purchase price is typically maximized over any other options, but you lose control over succession and legacy. So those two last pillars that we looked at, the succession and legacy, essentially you're giving that up for basically the optimal purchase price. So there's some considerations there, as well as different deal structures. So generally we end up in some kind of negotiation where we're structuring the deal, whether that's going to be cash, might be some vendor take-back loans there, possibly some earnouts where the purchaser wants to see some kind of level of performance post-closing in order for you to receive your full purchase price. Like I said, this option will provide you with the maximum purchase price, but it's dictated by the market. So you can't assume that there's going to be an external market or that the demand will be high when you are ready to sell. So you should always be looking at growing the health and value of your business, and you should be prepared and actively consider selling on a regular basis. So I see that quite often, actually, and in Northern Ontario especially, finding a buyer can sometimes be problematic for some very small owner-managed businesses. So it's important that you understand the market. If you're getting some offers, how many of these offers are really going to be available down the road? So you should be really considering selling at any point in time as well. The timing for this transition is about 1 to 3 years. And lastly, it addresses any succession issues. So I mentioned at the very beginning, one of the key areas of concern and problems is that, especially in Northern Ontario, is we don't necessarily always find or able to find the next successor. So ultimately, this plan here, or this strategy, eliminates those succession issues. So you're basically just selling out. Some top traps to avoid. First one, assuming that people, so family members and employees, are either interested or not. Again, we never want to make assumptions. So we're interviewing all family members, the employees. We're determining what their vision, what their goals are now into the future. Do they want to be owners? We're not making any assumptions whatsoever. Eliminating management from the pool of available successors because they can't afford it. So again, they may be the best suited successor for your business if that's really ultimately what you desire. So we don't want to discount that just because they don't have the financial backing to pay you out outright. So there's a lot of strategies in place and creative mechanisms that we can put in place for you to get paid as well. Picking the wrong successors, so not defining eligibility, selecting too quickly, or making a blanket offering. So again, when we're analyzing that second pillar, the succession pillar, is we're creating criteria to assess your possible successors. We're determining what their strengths, what their weaknesses are. Sometimes we'll identify weaknesses, and if it's early enough, we can work to turn those into strengths. So maybe they're not really business savvy, so we might send them to do a business course somewhere, which will help with their understanding of business in general and lead to a good success. Assuming that equal is the same as fair, and I think I've touched base on that quite a bit, so just hover over that one. Assuming that everyone sees the future of the business the same way. So we don't want to be making assumptions again. We want to know where people stand, what their visions are, what they ultimately see for the business, and we want to be on the same page. Starting too late, which generally causes us to lose key people and also lose some tax advantages. So Renee will touch base on the tax advantages later on. Losing key people, again, if you're not planning ahead of time, so say like 5+ years, and you're not involving the key people in those discussions, they may not see a future or a possible future that they can be business owners. So if they're really driven people, they want to move up in the organization and grow into business owners. If they don't see that opportunity, most likely you'll lose them if you're not having those discussions. Establishing a price without a clear basis for value. So again, we want to assess your business critically, of course, through the same lens as a purchaser. And then we ultimately want to determine what the value is of your company, as opposed to just saying, I want $1 million when I retire. We don't know where that $1 million came from. Apparently that's $1 million is a pretty popular one. I get that quite a bit when I have discussions. Everyone wants $1 million for their company, but really it doesn't come down to establishing a price. We want to see what the value is. We want to build that value through the transition leading up to the ultimate exit, and we're making a reasonable evaluation at that time. Putting all eggs in one basket, so not having a plan B, is another top trap there. So we want to have a plan that is flexible. Plan A can't be fulfilled for whatever reason. We know what the plan B is ahead of time. We've already put some measures in there that can be shifted, and we can move to the plan B and maybe possibly plan C as well. And lastly, not involving professional advisors. Again, there's a lot of technical aspects to this. There's a lot of facilitating of conversations that generally seems to be a lot easier when an advisor is present. But definitely the technical parts, so putting together shareholder agreements is important. Estate planning, retirement planning, tax planning, Those are all very important pieces of a succession plan, and we need to be involving professional advisors throughout the entire process. I think that's it for me. Renee, I think I'll jump on and go over some of the tax considerations and planning. So I'll just stop sharing, Renee.
Yep, thanks, Luke.
I just wanted to encourage anybody at this point, obviously, if we do have any questions, I mean, this is going really well. I'm finding this extremely insightful, and I don't even own a business yet. So this is excellent. But yes, if you do have any questions, again, please don't hesitate to pop them in the Q&A box at the bottom, and I'll pass it back to Renee.
So good afternoon, everybody. So I'm going to spend a few minutes this afternoon just talking to you about some of the planning options and some of the tax considerations that we look at in any succession planning. Yeah, to Luke's point, I mean, even from a tax perspective, it is very good to identify that you want to do a transition ahead of time. There's certain tax rules that we need enough leeway in order to meet some tests that are involved in qualifying for the capital gains exemption, for example. I'll talk about that a little bit more. So it's really important to get your mind set on kind of a general area. There's always going to be the one-off when you're not looking to sell and somebody wants to buy you and you get a letter of intent and it's too good to pass down. In those circumstances, usually the tax considerations are always secondary anyways because the price is too good to pass up. But in a perfect world, we'd always have your company ready from a tax perspective, ready to sell. So I think Luke touched on some of the options already, but so I'm going to go through a couple of these and some of the structures we see and how these are done, and maybe some of the considerations that we look at from a tax perspective in each of these scenarios. So selling the business or part of it, you don't always have to sell all of it. Passing it on to the next generation, you know, transferring it, having the family continue to own it. Sometimes you can have just add family members to the existing business so that you're running it together. And then there's combinations of all of the above. So really any kind of planning can be customized based on your specific situation. I've seen it all. I'm sure Luke and Joel have seen it all. There's always different family dynamics or employees buying in. There's always a different circumstance for everybody. So there's no one size fits all solution ever. We have a lot of tools in our tool belt, and we customize it in order to meet your objectives. So one of the first things one of the most common ones, and I think this is the one we see most in practice, is just somebody selling a business. They're selling the business. So from a tax perspective, there's generally a couple of ways that you can sell your business. You can sell the shares of your business, or you can sell the assets of your business. And in some circumstances, we look at a mixture of the two. And I'll talk about a little bit of how these are modeled. So from a buyer's perspective, so when you're selling the business or you're buying a business, you generally want to buy assets. And the reason why people want to buy assets is because you can maximize your future tax deductions. So when you buy assets of a business, you're buying it at fair market value. That becomes your cost base of the asset. You can depreciate that asset and save taxes as you go. When you buy shares, you're buying the tax attributes or the cost of the assets of the original purchaser. So you're not getting a bump in the value of the assets that you're buying. You're getting the existing balances. So that's a lot of the considerations when we're looking at it from both sides. And I've been on both sides on many occasions. It's from the buyer's perspective, we want to push for assets, but we also understand that a seller would maybe want to sell shares because of the tax benefits that are involved in that. So an asset purchase is a far less simple transaction or far more simple transaction than a share deal. Because you're not inheriting the history of the organization. You're starting fresh with a new company and you're just buying the assets free and clear. So it's less kind of reviewing the history and seeing if there's any skeletons in the closet. So that's a very attractive a lot of time from a buyer's perspective. And the other thing too, from a buyer's perspective is availability of losses, like I said, the tax basis on assets. If there's a big difference between the fair market value of the asset and the cost on the books. We look at things like the ability to maybe bump up the cost of assets to fair market value. Again, this is very technical ways to do it. And then we're also looking at taxes, especially if property is involved. If you buy an asset, you buy a property, or you buy the business with a property, land transfer tax is generally applicable. And when you're buying a shares, the building is not changing owners, so there is no land transfer tax. So there's a lot of these things to consider when buying. Is it going to cost me more to buy assets than it would shares? So sometimes the cash flow becomes a big consideration in whether you're buying assets or shares as well. So a lot of these factors are all kind of weighed in together and generally form part of the negotiation process. Sometimes you'll get an offer a certain way, but you want it the other way. And it just goes back to negotiating with the buyer and seller. And lots of the times the accountants get involved and we start looking at specific things like future tax shield on assets. So if we buy shares, what are we losing in future tax deductions because we're not getting the assets? So a lot of times the accountants will get together and do some math and provide some advice to both the buyer and seller in that perspective. Now, from a seller's perspective, a share sale. So as an advisor, I'm always looking to get a share deal where possible. There's always some circumstances where we can get assets, and it also depends on the value because the lower the value, the more simpler it is and the less tax advantage we have of selling shares versus assets. Now, there's no magic number. It's not like, oh, every sale under 200,000 should be an asset sale or share deal. It's got to be a case by case basis. So I wouldn't say that there's any hard fast rule. It just we have to look at it and see what makes sense. Oftentimes with the share deal, the compliance costs and the professional fee costs are a little bit higher than an asset transaction. So sometimes it's a cost benefit analysis to see if it makes sense. But the reason why we often want to sell shares is because capital, for one, we get a capital gain. Capital gains are the lowest type of income lowest taxed income that you can have because it's only half taxable and then it becomes income. You have access to the lifetime capital gains exemption, which is an exemption that every Canadian has, but it's only applicable to small business corporation shares, qualified farm property, or qualified fishing property. So the asset that you're selling has to qualify and has to meet certain rules and conditions in order for you to get the exemption. Now, right now, the exemption is $974,000. So if you sell your business for $974,000 and it meets all of the conditions, there'll be no income tax. Now, there could be potentially some alternative minimum tax, which is not a permanent tax. It's more of an upfront tax that you get back. I won't go into the specific details of that because it's a little complex, but generally the tax would be tax-free. The gain on the sale would be tax-free. It possibly could be simpler in a sense where you're not selling individual assets and identifying assets and transferring them all. Sometimes people prefer to buy a business that is ready to go. It's turnkey. So when you buy shares, all of the structures in place, all the government accounts are in place, the bank accounts are in place, all the agreements are in place, everything's in place. Where when you buy assets, usually you're going to set up a new corporation and you're kind of starting from scratch. And then there's all kinds of things like employee severance, and there's just a myriad of things you have to consider when you're buying assets versus buying shares as a purchaser. So sometimes from that aspect, a share deal could be simpler from kind of like all of the administration and soft issues you have to deal with in buying a business. So again, tax, like I think Luke mentioned already, is about 10% of what we need to consider in a succession plan. There's all kinds of other issues that we have to consider. Like tax is important, of course, because it affects cash. It's what we end up with in our pockets at the end of the day. But as far as what we consider when we're considering everything, it ends up being a smaller portion. It's also a little bit easier it's very kind of direct with respect to how to get the cash. Usually it's just whoever's selling it, they get the cash. Whereas when you sell assets and you own a corporation, all the cash is going to go into your corporation, and then you got to get it out. And then usually there's ways to get it out efficiently, but generally you'll get it out over a period of time, and you'll get taxed as you're removing the money. Whereas a share sale, you usually get all the cash up front. In most cases, sometimes there's a vendor take back, but you get most of the cash up front, and then it's in your genes. You don't have to worry about maintaining a corporation going forward. So it eases a lot of the administration as well. Some of the other things we look at, is there losses in the corporation? What are those tax balances? What's the cost of doing the tax due diligence? What's the shareholder mix? Sometimes there could be multiple shareholders. So we have to make all these type of considerations, and every business is a little bit different. And then often we'll look at situations where maybe a hybrid transaction makes sense. Maybe the seller really wants to be able to use their capital gains exemption, but the buyer really wants to buy assets. There's ways to do transactions, and I won't get into the technical aspects of it, but where you can have both a share sale and an asset purchase in one transaction. So that's generally left for larger transactions where the cost of making a hybrid transaction, because it is a little bit more expensive to do, is worth it. So again, case by case basis, and we discuss with clients. A lot of the times it's not presented at the time of a letter of intent is received for a sale of a business, but something that the advisors, we look at and we discuss with the seller or the buyer, their comfortability with a hybrid transaction. So I would say that it's probably like 1 out of every 50 that I see personally. I know maybe some other bigger centers or maybe more, but it is something that we do look at, and we do provide options for if somebody's so inclined to go down that path. So I'm going to transition now. So that's generally just selling to a third party. And a lot of those, again, is a lot of the soft issues, and a lot of it is negotiating. And to Luke's point, that's probably going to get your best price generally, because the market's going to bear it. I know we've seen a lot of this type of activity in the last 2-3 years, a lot of businesses buying and selling. I think it's slowing down a little bit. Some of it probably to do with some of the interest rates and some of the kind of the tightening we're seeing in the economy, but definitely has been a lot of activity in this area already. And most of the time I would say most of them I've seen are share deals, but I've seen still a number of asset deals as well. And again, it's just we customize that and provide advice to you, and provide actual calculations, and we model out each of the scenarios so that you have an idea of what the expected cash flow is under each of those. This is one that is new, and this is one that it become a lot more prevalent, or became prevalent in the last 1.5 years. And this is intergenerational transfers. So what we look at with this is when a parent wants to transfer their business to a child, and we want to do so from a tax efficiency standpoint. So just to back up the clock a little bit, and I know it's not on my slides, is that we couldn't do this before. So pre-Bill C-208, which was a private members bill that passed in 2021, we couldn't sell the business to a child and have them use a corporation to buy the shares. They would have to find money personally to do it. And that is really tax inefficient, because even if you bought the business and you're getting cash flow from the business, you would need to take it out, get taxed on it personally, and then use the after-tax cash flow to pay mom and dad back. What this Bill C-208 allowed is kind of create a structure that allows a child to buy a business with using corporate funds pre-tax. So you're not using personal funds, you're using after-tax corporate funds and not after-tax corporate and personal funds. So we kind of eliminated one layer of taxation in these business transfers, and that put everything back on a level playing field. It was really a disadvantage for business owners to try to sell their business to their children. And this is something that was identified by us and a lot of other accounting firms. And we have been lobbying for some fairness in this area for some time, in order to allow business owners to be able to still transfer the business to their children, but to minimize some tax and leave more of the money available for them in retirement. A lot of the time, that was kind of the stumbling block in parents selling to their child, was the income tax consequences of doing so. So back to intergenerational transfer. So what are some of the conditions we look at? One, the shares have to qualify as a qualified small business corporation share. Basically, there's a series of tests that you have to meet in order for you to qualify. I'm not going to go through the technical details of what those conditions are. That's something that we do. However, there is a 2-year test. That's a 2-year look back rule. That is the one that can get us into trouble. So that's why when you're saying we need to transition, think about it 3 to 5 years. Some of it is for tax purposes. One of the things that can throw your company offside is if you retain too much passive assets. So if you have an investment portfolio, you have rental properties, you have excess cash that you're retaining in your corporation, that can actually throw it offside for qualifying as a small business corporation. Now, there's ways for us to help clean up that corporation. We use a term called purification. If you've ever heard somebody say that, that's what we're talking about. And all that is just removing the assets that are not required to operate the business. So usually we set up a holding company and we move assets over there. So that is a key component in order for this to happen. We can make it qualify if we need to through reorganization prior to any transaction, but it's always better to do it ahead of time and keep doing it actually, and keeping a structure that allows your business to be sold at any time. So that's why you'll see maybe chats around the coffee table or with a beer with somebody and they're talking about a holding company, or I got an investment holding company. And that's the reason why we set those up, is so we can keep the operating company clean for future sale and also for creditor proofing purposes as well. So again, back to the criteria. So taxable capital, that's just the size of the business. It would kind of restrict these type of transactions to smaller family owned businesses. We don't want it to be, legislation wasn't really meant for this to be done with large privately held corporations. The purchasing, there's got to be a company that your child incorporates. So they need a company, they create one with a lawyer, and they use that company to buy the shares. That child or grandchild has to be 18 or over, and the purchasing company has to retain those shares for at least 60 months. So it's got to be something that we want to have this succession occur, and it's going to be natural, and we want this business to go over to the child so they can retain it for that period of time. So what are the kind of stipulations with the 60-month? During this period, we cannot exchange shares, so we can't change any of the structure, we can't amalgamate, we can't wind up, and we can't do any rollover. So basically, the structure on the date of the sale occurring has to be retained for 5 years. Now, I think some of the thinking behind this is that people didn't want to utilize, or the finance department didn't want people to utilize this as a way to extract cash cheaply out of a corporation. They wanted to ensure that these were proper successions and that people weren't using it solely as a tax planning vehicle. Some of the things that we have to consider when we do these transactions is you need an independent assessment of fair market value. So CRA needs a report from a reputable or certified business valuator, or somebody that knows the business well. You can't just not do it in an assessment of the value of the business, because it has to actually be filed with CRA. They will request it. So in our firm, for example, we have certified business valuators that will do an evaluation of the business, which is essentially boils down to historical review of your business in comparison to industry factors and regional factors that you have in your community. They look at recent transactions, if there is data in your industry sector, but they'll determine a value, and that's the value that we end up using in part of a transaction. So it's very important to note that when you transact with your family members or anybody who's not arm's length to you, it has to occur at fair market value. So all the consideration has to be fair market value. When you deal with somebody outside, like an employee or an outside buyer, a lot of that market will be set through the negotiations with that person. I would say even with an employee, a lot of the times an independent assessment or evaluation of the business would be recommended, so that even though an employee may not be related to you, you could be deemed to be related if you have like you're working in concert and you kind of have a close working relationship. CRA can kind of dig through that and determine if you guys were actually dealing at arm's length or not. And a lot of that is just like the hard bargaining and negotiating that goes on generally in an arm's length transaction, which identifies that the parties aren't acting in concert. We also have to provide CRA an affidavit when we do these type of transactions. So that's to be signed by the taxpayer and a third party, attesting to this disposal of shares. So they just wanted to make sure that, you know, this is something people are doing for the right reasons. And this is why CRA implemented these, to ensure that there's less risk of people, you know, abusing this legislation. So one of the things that we look at and why we look at these transactions now and why we're so happy that they're there is the differential in tax rates. So as I indicated before, lifetime capital gains deduction is available. It's $972,000 this year, and it gets indexed every year. So it went up about $50,000 from last year's rate to this year's. So that first $970,000 could be completely tax-free. And then even if a portion of it is taxable, it's only taxable at 26.7%. That's the highest rate. So that means that your income would have to be in excess of $220,000 for that rate to kick in. Otherwise, it's ramped up through the tax brackets. The other income that we can get from a corporation, another way to kind of get out of the business, get your cash out of the business, would be to pay yourself a dividend. And the top rates on those are 39%. That's if you can pay an eligible dividend, which is essentially a dividend that's paid out of tax earnings that were taxed at the general rate. So we have two tax rates for corporations. We have a small business rate, which is 12.2%, and then we have a general rate, which is 26.5%. Usually you pay the 12.2% on your first $500,000 of earnings if you qualify as a small business, and then anything in excess of that, you're paying 26.5%. That excess, or whatever's paid at 26.5%, goes into a pool that can be paid out as an eligible dividend, which is why it's a lower dividend rate than this other eligible dividend, which is 47%. So oftentimes when we're talking about transitions with family members, I'd like to look at this slide and explain the differences between how you will get taxed on getting paid for that business. So before, it would be very difficult for us to get in that 0%. Again, the child would have to come up with money personally in order to buy the shares so mom and dad can get the 0%. Whereas now we can do it with the corporate funds and we won't have to come up with the money personally to do it. So again, yeah, there's a bias to reduce the tax rate. Of course, we want to do that wherever we can. So what does it look like from just like a pure planning standpoint? What does the structure look like? Parent owns the operating company, child incorporates a purchase company. Purchase company will buy the shares from mom and dad. Purchase company will issue a promissory note to mom and dad. And then over time, the operating company, as it earns money, will pay or loan the money to the purchase company, in which they'll use that money to repay the promissory note. So that can be done over a period of time. Of the ones we've done, the repayment terms have been generally 5 to 10 years. It all depends on the availability of the cash flow from the business and the value of the company and how much money we're going to need. The other option too, and I haven't seen many people go with this, especially with interest rates the way they are, is child can go to the bank and get financing and put it in their purchase code to purchase the shares from mom or dad. So that could be in a situation where maybe some more cash flow is needed up front. But normally we can kind of plan for that depending on the cash flow needs of the parent and whether it makes sense to go get bank financing and pay that higher interest cost. So this is probably one of the more prevalent ones we've seen lately as we see business transfers to parents. I would say that there is a threshold because it is costly to get an independent assessment and to go through these transactions and setting up these entities. So it's a case by case, but generally we want to look at sales that are going to be more than $500,000 and up, I would say, just to kind of from a cost benefit standpoint, not erode the tax savings by having all this additional professional fees involved in the transaction. So it's not for every type of situation. It could be a little bit more complex if there's multiple children and maybe they all don't want to be part of the business owner, but we want to preserve some ability to have some shares for the other children that are not involved, because we want them as part of their estate plan to get something from the business. So it doesn't work in every situation. What we look for is a true business transition where the children are going to take over the business and mom and dad are going to be bought out of the business, and they need the cash. They want the cash from the sale of the business because they need it for retirement. So what are some other options we look at if that doesn't really fit? So there's a myriad of things we look at. One of the simple ones we look at is just gifting shares. So we just say, mom and dad say, here, I'm going to gift my shares to my children. This is something we use maybe when it's a smaller value, or mom and dad does not need the cash. They have plenty of other retirement assets and they don't need any cash flow from the business anymore. And they just want to gift the shares to their children. Things to note about this is that even though you're gifting it and it may be a nominal value, there's no cash being exchanged, it's still taxed at fair market value. So we still need to do a value of the business. If the shares qualify, and a lot of times we'll ensure this does, so there's no kind of outflow for mom and dad, is that if the shares qualify at the time that you're gifting it, you can use your capital gains exemption, assuming the shares qualify again. So a lot of times this is a very kind of a cash-free, simple way of transitioning the business if we meet the criteria. And one thing too about gifting shares, and sometimes we use this anyways, is that generally gifting, and I'm not a lawyer, so you get legal advice, but a lot of the time we use that because it's not part of net family property. So it's a good planning tool that we use, and it's very simple. It's a simple transaction. It's probably the simplest way to transition the business off to a child if there's no cash flow needed out of the transaction. Now, I mentioned that, in our previous slides, you could sell using the holding company or a purchase company. If you don't want to do this, you could sell it to the child straight out and say, you know what, you figure out the cash flow out of this, you're going to take business money out of the company, and then you could pay me with your after tax. I always still want my exemption. So I do see these sometimes. Sometimes it's also when the business is a little bit smaller, or for some reason the child has some cash flow available. It's just a lot simpler and less complex than setting up that structure in order to do the buyout. So definitely an option. You can definitely look at this. It's just a matter of making it efficient for the purchaser.
Renee, at this point, just because we have one question that reads, if you have two partners selling a business, do they each qualify for lifetime capital gains, or so they share that value fairly? Are they considered related?
Well, like if you have two partners selling to a third party, each have their own exemption, and the determination of whether you get the exemption is based on the corporation. So it would just be, it's really the corporation itself has to qualify, and then how much of the exemption you get each partner would depend on how much of the exemption you've used or not used yet.
Thank you. And I see that Joel was probably typing a follow-up there, so I'll leave him to it.
Yeah. So yeah, so very simple, just to sell shares to the child. One of the reasons why some reason why we may not want this is that the child won't be able to transfer that debt to a corporation to service it. They'll have to continue to service it personally. There's some tax rules that don't allow us to do that. So unfortunately, it's not the most efficient structure if you have to get financing. If you have the cash available, or if it's manageable, you can do it. It's just not the most efficient way. So we then look at some other options that can have the company do the buyout still, but we don't have to get into the complex planning of setting up companies or selling shares. And we generally refer to that as an estate freeze. So this is where we want the child or the grandchild, whoever, to, even an employee you can do this with, is freeze the value of the corporation. So all we're doing is we're kind of taking a snapshot in time, drawing a line in the sand, so to speak. We're saying at this point in time, the company is worth X. So all of that value up to that date is going to belong to the existing shareholders. And then from that point forward, we can introduce new shareholders at nominal value. So this is the one that we used often before with children, before the intergenerational transfer legislation came in, and child would come in and acquire the common shares for $1. Mom and dad would have preferred shares, and over time we would start buying, the company would start buying back the preferred shares, and that would be paying for mom and dad's retirement and part of the succession. So we use this often, even in conjunction with a family trust. So instead of having a child own the shares directly of the business, we implement a family trust. I'm not going to get into the full details of a family trust, but a family trust is basically made up of trustees, people who control it, usually mom and dad, and then beneficiaries, people who could benefit from the trust, and we usually put all the kids in there. We use that often in situations where we don't know how equitable or fair it's going to be to give one child shares or another, and we don't want to deal with that maybe yet, or the parents don't want to deal with that. So we set up a trust, and then all the kids are in the trust. It's fully discretionary, so that we don't have to give one child one without giving one the other. There's flexibility in there. So we use estate freezes when maybe it's not viable to do the transfers, just because we don't want to do the structure or anything like that, and we just have the company kind of fund the retirement through the buyback of shares over a period of time. And it spreads the tax liability over the years, so you can do it. I've seen some where we've done redemptions over 20 years. So as you're redeeming the shares, you'll get a dividend, and that dividend going your personal tax return, you'll pay a little bit of tax every year as you're getting the cash. It's not the most tax efficient way to do it, because you're not getting a capital gain. Capital gain is always the best. However, it's a way to kind of spread out tax liability over a period of time, keep the structure pretty simple, and allow somebody to enter the business without having any cash flow or having to put any cash up forward, really, and having the company just kind of pay for everything. So that's probably one of the most common options. Like I said, these are kind of what a structure would look like one way or the other. We just have the growth of the business kind of on a go forward basis belong to the children. So as the business grows, all the value goes to them. And even as the preferred shares are bought back from the company, that would, assuming the business stays at the same value, would increase the value to the common shareholders. So that's just a very high level kind of thinking that when we look at these, I would encourage you to, think about your situation and start those conversations. Like Luke said, from a tax perspective, we could tailor any kind of structure that's required to meet your needs. The more time we have ahead of time before the intended transactions, the better we can do from a planning perspective. I think keeping your company ready to be sold once it's well established and it's kind of it's in its maturity is a good thing to always think about. Should always think about keeping your company clean, keeping it ready for sale, making sure to keep passive assets outside of the corporation if you can, and make sure that you're speaking to your advisors we're here to help, and we have a lot of experience with these types of things. And we work with the financial planners, we work with your investment advisors, we work with the lawyers. We all kind of work together and try to have a team approach when it comes to these types of things. So that's it. I think that we've given you a good overview of things that you need to think about and start considering, and some of the planning tools we do use and what's available out there for you. But the main thing is to recognize when you need a succession and speak to an advisor.
Well, I can definitely assure you that you have given a both in-depth and high-level overview, because I can tell you that I've certainly learned quite a bit, even just from the three of you today. This is absolutely incredible. Thank you so much for taking the time. Just while I sort of allow some people to populate the Q&A box, should they have any questions, I will know that Jamie, or one of our participants, has asked the question: what are some planning issues with liquidation option? They ask.
I don't think there's any issues with the liquidation option. Just there's some tax consequences. So you'll just pay tax on any gain on the sale of those assets, and then you'll pay tax again when you need to take the money out of the corporation. So that's just about managing the tax liability. Sometimes liquidation is the only way, because we can't find a buyer for the assets, and so or for the business. So we're just selling assets to anybody who wants to buy it. We don't really have many options from a tax planning perspective when we get that, because we're just converting assets to cash, and then from that point forward we just have cash. So you can I've seen it where business owners will reinvest that cash in liquidation and maybe buy some real estate or some investment properties and allow that cash to grow a little bit more before they deal with it. But other than that, I don't know if there's a whole lot of additional planning to consider.
And, certainly, while you said it was a team approach, and I know we've had this question from a couple of our members, when you're looking at where do I start? Is it, do I visit the lawyer? Do I visit the financial planner? Or do I visit the accountant first? Or is it sort of a team approach on this?
I don't know if I think the way that we try to work it is, it doesn't matter who you talk to first. I think we all recognize what each of us brings to the table. So I think it's just, we deal with the nuts and bolts of a lot of the things with the succession, but it's certainly, I would say, reach out to any of them, and we'll kind of all end up in the same place at the end of the day.
That's encouraging news. And you know what, I do want to just harken back to the beginning of your slide, well, one of your slideshows, I'm sorry. The CFIB stat noted that I think it was 51% were without a formal or informal succession plan. Here in Timmins, that looks like about 75% of locally. Within our membership, there's about 220 locally family owned or operated businesses in Timmins. They employ nearly 10,000 of our workforce. So, how critical is it that they begin thinking about this? You said 5 years. When's the time, and how critical is it, given the fact that they employ 60% of Timmins workforce? I guess the question is, how critical is it? I mean, you went through so much information today, but
I would just reiterate from a tax perspective. I'll let Luke jump in on the succession piece. It's critical. I always tell people I need 3 years minimum to do a proper succession plan, to make sure that things are in place, because there's some tax consequences, and I didn't get into this a lot in my presentation, but because it's very complex. But if you try to clean up a company just before selling it, you can't do it on a tax deferred basis. There's going to be tax. So the more time we have ahead from a tax perspective, the better.
I'll certainly let Luke answer if he has anything to add.
Yeah, for sure. I'm going to just touch base on some of the succession points, and really the sooner that you can get started, the better. We found, and the stats that I provided, they were just nationwide. So of course, what we're finding is in Northern Ontario or smaller communities, those ratios are a little different, and even more so, some of the issues is actually finding a successor. So you want to start as early as possible, especially if the successor pool or available pool of successors is not necessarily there, and you want to groom someone into a successor. You want to really identify that criteria. What's the strengths, weaknesses? we want to train these people, build up their weaknesses. If we want to be transitioning with a succession in mind, keeping that kind of legacy and keeping it within an employee or management group or a family member. So the sooner the better, of course. In terms of, again, selling to third parties, generally that is not necessarily a big issue, but what we're finding is some of the smaller owner managed businesses, the market is not always there. So again, we want to be identifying potentially, or at least analyzing or figuring out what is that market now, what's it been like in the last 5 years, and then try to make some kind of assessment of where is that market going to be, because that might limit our options in terms of a third-party sale. So we may not have the market there to sell. So we really have to look at that succession, building someone up for that. And if that's not possible, then ultimately we're going to be kind of left with that liquidation kind of option, which is going to be maybe our plan C, that we just don't have any other choice to go with. So.
Well, I think it's important you mention it that way, because it is cyclical, like anything, the industry, sector related, selling a house for that matter, it's all going to be related to sort of these up and down cycles regardless. And then the other thing that you did mention as well was, there is that, well, I won't be delicate about the situation. There's the while you're still alive component, but there's also the break glass in case of emergency type component as well, where it's much like a life insurance policy. If you don't have any plan in place and, something critical were to happen to your health, then, you need to be set up for success as well.
Yeah, and that's where often anytime we're doing estate planning, we always like to talk to the investment advisor and the financial advisors, because we want to make sure that kind of all the boxes are checked, and life insurance is definitely one thing we're always looking into for our clients. And then one other thing, with just respect to timing, it's never too early to think about it, even if you think it's too early. Sometimes from a tax perspective, when we're doing planning, and we want to multiply capital gains exemption to have a really successful business. And as I noted, the capital gains exemption is about 970,000. So sometimes we have businesses selling for 5, 10, 15 million, and you can have children involved in that, but you got to get them involved early. So from a business selling standpoint, if a really successful, fast growing business, sometimes it's good to start speaking to your accountant early to maybe put in a structure in place that's going to give you the most tax advantage down the road, and also give you avenues to keep your company nice and clean and pure as you go, as opposed to kind of dealing with it when a sale is imminent.
From an advocacy standpoint, the Chamber Network was certainly pleased, I think back in 2018, to submit such policy resolutions to ensure that those capital gains exemptions were realized, and it was like partners with MNP that we were able to see that success through new legislation. So we were very pleased to see that pass, number one. And number two, it's important that we continue talking to not only MNP, but our partners as well, to understand what things that we can do with legislation, particularly alignment or removal of red tape, policy procedures, etc., to make sure that this process, as daunting as it may seem, is very accessible, and that you're well supported with the appropriate teams in place, such as all of you who have joined us today. So with that, I want to sincerely thank our succession planning pillar partners, which are proudly supported by Genier Financial, of course, Danielle and Ryan, Maisonneuve Dawkins lawyers, Renee and MNP, of course, Joel, Renee and Luc, who have joined us today, who have provided critical support to this very important session. The next in our series, of course, is going to look at the blueprint for business transition. That is two sides of the coin. We're going to be hosting that with Ryan Perkins and Danielle Genier of Genier Financial. So we encourage you to register for that one, and keep an eye out for the upcoming session with Renee Maisonneuve of Maisonneuve Dawkins Lawyers on February 15th. For these sessions, events, workshops, or anything for that matter, do visit our website, timschamber.on.ca. You're going to find all of the information to register, including some of our programming. In the next week or so, our board is going to be reviewing our new, I'll give you a sneak peek at the title, Business Succession Planning Report, which features 100 of our locally owned family run and operated businesses, and an insight into where they are with their succession planning or lack thereof. So as a result, I want to thank everybody for joining us today. Thank you again, gentlemen. I greatly appreciate your time and expertise. Do reach out to them, and we'll share this recording as well as copies of the sort of final public-facing presentations for your review as well. Take care, stay safe, and look forward to the next opportunity. Thank you.
Great. Thank you very much for having us.
Take care now.
Thanks, everyone.
Bye.